Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome to another episode of Bloomberg Deals, the only show dedicated to corporate action reshaping markets. On today's episode, we talk with Blackstone's Joe Baratta about how private equity is navigating M&A in a very volatile market. Today, we're also focusing on activist investing as Bill Ackman urges Universal Music Group to merge with a SPAC to list in the U.S. And later, my exclusive conversation with Matt Zimmer, Global Head of Investment Banking at William Blair. Let's get to today's big deals, and bring in the reporters behind the headlines. Now, despite geopolitical volatility, AI deals have continued at pace. Pimco is the latest debt giant looking to add to its AI financing portfolio. People familiar telling us that the bond backer is in early talks with Bank of America to help provide roughly $14 billion of financing, debt financing that is, to Oracle for a data center in Michigan. Bloomberg's Laura Benitez joins us now for more on this. Laura, what do we know about the deal?
So this financing is for a huge data center in Michigan, where Oracle plans to power applications for OpenAI. It requires a huge amount of financing and some equity as well, obviously. There's been quite a few hurdles in putting all of this in place, and it's taken a while, but it looks like some of those obstacles have started to clear. So that lays the way for the financing talks to be pursued.
Can we go through some of those obstacles, Laura? Because whether it be from Wall Street and jitters around financing markets to even locals, it felt like this is a deal that had a lot of resistance.
It did, and there was multiple levels to it. So on a local level, there was a lot of resistance towards development, and the developer faced a lot of challenges in being able to actually build out the data center. They did get the they did get the approval to go ahead and build, I think, in January, but until then, there was this kind of back and forth. And also on the lending side, until that is cleared up and in place, it's difficult to really put terms in place. But we do hear there has been a lot of negotiations around lease terms. This will be debt that will go into an SPV. So there's lots of back and forth. And, you know, these financings are never straightforward.
Certainly not. I know their second large one after backing a Blue Owl and Meta deal. Laura, thank you so much. That's Laura Benitez on the latest with Pimco. Now, elsewhere in activism, Bill Ackman is taking aim at Universal Music. Again, Bloomberg's Scarlett Fu is here to brief us on the billionaire investor's latest proposal for the record label. Scarlett, good morning.
Good morning. Ackman's Pershing Square Capital is proposing a deal that values the music label giant at about $65 billion. Now, Universal's artists include stars from Taylor Swift and Bad Bunny to Billie Eilish and Kendrick Lamar, not to mention the Beatles and Elton John. Ackman's proposal includes merging Universal with a blank check company, moving the listing to New York from Amsterdam, selling Universal's stake in Spotify, and taking on new debt. On top of that, Ackman wants to appoint a fresh board of directors, including the former Disney chief Michael Ovitz. Now, this is not Bill Ackman's first dance with Universal. About 5 years ago, he tried to buy a 10% stake through a blank check company from Universal's then parent Vivendi. Regulators shot down the idea, so Ackman ended up using his Pershing Square hedge fund to buy a direct 10% stake. This time around, Ackman needs to win over 2/3 of Universal's investors, starting with French billionaire Vincent Blair. He's the single biggest shareholder with an 18% stake. Analysts are skeptical Blair will okay these terms. Now, what everyone can agree on is that Universal is undervalued. The stock is little changed from its reference price of 18.5 euros when Vivendi spun it off in 2021. And last month, we know that Universal said it would buy back shares to address a dislocation in the share price. So we'll wait to see how this all shakes out. Danny?
Thank you, Scarlett. And thank you for saying good morning back to me. I mean, I know it's not the morning. I'm just so used to saying it because of open interest. I'm aware it's noon and it's the evening. Scarlett, thank you so much. Now, another deal that we are watching comes from Gilead, the pharma giant. They've announced plans to buy German biotech company Tubulis for $5 billion in its third major deal of the year. Bloomberg's Michelle Davis covers pharma deals and joins us now. First of all, did I say that correctly? And what are the details behind this?
So Tubulis.
That makes so much more sense. Thank you, Michelle.
You know, it's biotech. There's always made-up names every day. But Tubulis is an interesting one because it was an IPO candidate. It's a private German biotech company. It was supposed to go public this summer, Gilead snapped it up before they could go public, obviously. And Tubulis is developing a drug for ovarian cancer, and it's in a class of drugs called ADCs, or antibody drug conjugates, that folks are really excited about because they basically the drug delivers, cancer-killing medicine directly into tumors. Gilead actually did one of the first big deals in this space years ago, and they already had a partnership with Tubulis, and they clearly liked what they saw, so they decided to buy it.
Yeah, so more pharma deals. Great reporting, Michelle. Also around the table with us this evening is Bailey Lipschultz. And Bailey, the IPO market, look, public markets are volatile, I think, is an understatement.
Easy way to put it.
But we got this IPO coming in the way this HVAC company, Madison Air. Is this kind of like breaking the dam of this IPO freeze it seems like we had?
Bankers really hope so, and they could raise up to $2.3 billion. So that would be the biggest deal in the U.S. so far this year. The big question does come back to some of the fundamentals. HVAC is top of mind, but how do you value that against some of the publicly traded comps? Do investors really still want a 20%, 25% discount to peers? And how does it get across the finish line? We also had ARC6 launch this morning, so we are going to have two deals pricing next week. Given the volatility, bankers normally will say they know the answers to the test before they take it. So the expectation would be that they'd get these off the ground.
What is the bar for pulling these if there is more market volatility next week? Or have they prepped everything and they're going ahead regardless if we get a day like today where stocks are up 3% or maybe the opposite where they're down 3%?
It's hard to forecast. When we saw the pair of deals pulled earlier this year, Liftoff, their comps were down about 45% in a few days leading up to pricing. And that's pretty much impossible to price a deal. And then on the flip side, you had Clear Street, which there was a lot of pushback to the valuation even before they formally launched that. So I think you would need a lot of volatility to really get these deals held up further. But the big question still will be what actually happens with the volatility.
Bailey, Michelle, thank you so much for joining. That's Michelle Davis and Bailey Lipschultz. Coming up, our next guest says that deal activity is selective, even with a new investment cycle driven by AI and industrials. We're going to take a look at the big picture. Blackstone's Joe Baratta joins us next, right here on Bloomberg Deals. Time now for the big picture, and I'm so pleased to say that joining us today is Blackstone Global Head of Private Equity Strategies, Joe Baratta. Joe, thank you so much for joining.
Thank you, Danny. Great to be here.
I would say, but before you came on, I was saying, what a great time it is to be in private markets and not have to worry about the crazy volatility day to day in public markets. But we are living through that of different headlines on geopolitical risk. How, if at all, has that changed your world?
We try to look through what's going on in the moment and look at the bigger picture. Is this a good company? Is it a good industry context? Are there weird things happening in the market that allows us to buy something more cheaply, or where we need to be cautious of where the valuations are? So we really try to disassociate from like the moment, the 5 seconds that we're in today.
It sounds like
the bigger picture.
The place that you don't, though, are where there are opportunities. If there are weird things happening in the market, are there places of dislocation now that are especially attractive?
Yeah, I mean, we try to invest thematically, and where we've had the highest conviction is in the electrification of the U.S. economy. There was a real lack of capital by big utilities in expanding power generation and in improving the grid. And those companies, like when we started investing in them 5 or 6 years ago, were actually pretty cheap. And we saw an opportunity for these companies to grow at structurally higher rates than they had, and then hopefully get some multiple expansion. I think that's happened. So we try to look for opportunity in a more thematic way, but also, you know, we have to be opportunistic. When an individual stock gets hammered and we think it's a good business, we may begin to look at it. Certainly when sectors are out of favor, we start looking at them to try to find things where the market might have thrown the baby out with the bathwater, so to speak.
I have to say, just an obvious sector that feels unloved has been software. Are there proverbial babies that have been thrown out with the bathwater there?
I think there certainly will have been. I do not subscribe to the view that, you know, SaaS is over and the whole sector sort of, you know, in decline forevermore. I think like in any maturing sector where you have some significant technology innovation that could disrupt the profit pools in the sector, you will have winners and losers. And I think there will be companies with great embedded business systems that companies rely on that can use AI to make those systems operate more efficiently, to make the companies that are running them better. But there will also be more simple point solutions that will probably go the way of like Yellow Page assets in 2007. Our job is to make sure we're not buying the Yellow Page assets.
Yeah, certainly. I mean, it does, though. It has created this market angst. And our reporter before, for example, was pointing out liftoff and IPO from you all that got paused. How are you looking at the pipeline of IPOs when the market is treating these stocks with a lot of volatility?
Yeah. Well, we actually did a very successful IPO back in December, and it's traded well even through all the dislocation. The company called Medline. I think the market,
huge IPO, by the way.
Huge IPO,
huge one.
Big company. And the reason that got public and it's traded really well is because it is what the market wants. They can't find a way, public investors can't find a way to play what Medline offers without buying Medline. It is important to its customers. It's critical healthcare infrastructure, serving nearly half the hospitals in the United States with the things they need to operate every day. And so the market is open for companies like that. We have a few more in our stable. I saw before I came on the Madison Air going public. And that's the type of company that I think the market's going to want to own, immune from some of the AI dislocation and really good businesses with good secular growth trends. The market is open for those companies.
I hear a lot of optimism in your voice, but if you take kind of a step back and just look at the first quarter that was, corporate M&A markets extremely robust, but when it came to private equity specifically, volume was much more tepid, fell 36% from the quarter prior of last year, 8% if you compare it to a year ago. What do you think changed that made first quarter much less active in the grand scheme of things compared to the corporate world?
I think there's a lot of volatility, of course, in the stock market, particularly in sectors that private equity has tended to invest a lot in software and professional services and other things. And then, of course, you had a major global conflict, geopolitical situation, which hopefully is resolved. None of that is a great recipe for lots of deal doing. That being said, I think we will see a resumption in deal activity. And this year will be, for the rest of the year, I think it will look like a normal year of private equity investment and allocations. In fact, we announced a deal just a day or two ago in the UK, taking a company private. We've announced a few deals in our energy business in this whole electrification thematic. So we're still transacting. I think the huge volatility, which will calm, I think will create the conditions for more activity.
And of course, you have your life sciences fund you've closed as well. You closed Hologic too. So a lot of things going on, but can deal activity resume as normal even if you continue to get the geopolitical volatility we're getting? Does that need to ebb in order for 2026 to play out like a typical year?
Yeah, I mean, I think, like hostile conflict, involving the United States of America and key energy markets is not conducive to like a lot of deal flow and a lot of risk taking. So I think that will have to calm down. I think, today it seems like it has. We'll see if that persists. I hope it does. But, we don't have to invest in any certain period of time. I mean, we have private equity is great because we do have an investment period of 5+ years to deploy the capital. So there's no urgency. We want to find great companies at the right time at good valuations.
There might not be urgency to deploy, but there certainly feels like urgency to exit and to get distributions. What happens if it's a slower market and there are funds that are sitting on these aging assets and they're getting pressure from LPs to return cash?
Yeah, I mean, I think ultimately owners of these assets that are mature, stabilized, the firms have done what they wanted to do to make the companies better. They're just going to have to sell at the market clearing price, and we've been doing that with our companies. We've produced very significant liquidity for our investors across all of our private equity funds. We'll continue to do that, and I think the rest of the industry, many have done that, and the rest will have to follow suit if they want to stay in business and keep raising money from institutional LPs.
Is it, for lack of better terms, almost a reality check that these funds that haven't just are way overvaluing their assets?
I'm not necessarily convinced that it has to do with the assets being overvalued. It's just the hope of creating value from where they are marked, and there's no urgency on their part to sell. But at some point, yes, you have to clear the backlog. You have to take companies public. You have to sell them at the market clearing price. Like that is the job that we've been given to do by our investors.
By the way, but before you go, Joe, we have to talk about sports, because you all did two things, I have to say, that were very popular in my household. One was signing on Tommy Fleetwood as an ambassador, and then two is this IPL, the Indian Cricket League deal that you've done. I gotta say, I had to double check that it was the first ever sports M&A that you've done, which surprised me. So what's going on? Are there more in the pipeline? Is this Blackstone going headfirst into sports?
No, I mean, I think sports is definitely a long-term megatrend. If you look at where we like it is where it's early in the development, and certainly that is the case in India, which is a high conviction market for us. We were one of the largest private equity investors of the last 15 years in India. We're true believers in the economic expansion. And if the IPL is extremely well structured, it's like the NFL with revenue sharing. These are great franchises. The media rights are just beginning the escalation. We think there's a lot of upside in these teams, and we love investing in the growth of the Indian domestic market. And then with Tommy, I've gotten to know him and his family over the last 5 or 6 years. He is a great guy. He embodies what we believe in at Blackstone, which is hard work, a commitment to excellence, and he is that. And he's a really great human being. I was going to say,
is he actually the nicest guy in the PGA, do you think?
He is. He's super well respected by his peers. He's loved by his fans. He's a great guy.
Joe, thank you so much.
We wish him well at the Masters.
Hey, we all do. It's going to be an exciting week for that, Joe. Thank you so much for joining. We really appreciate your time. That's Blackstone Global Head of Private Equity Strategies, Joe Baratta. And with that, let's pass it over to Scarlett, who's keeping track of the latest geopolitical headlines. Scarlett.
That's right, Danny. President Trump posting on his social media platform that there's only one group of meaningful points in reference to the 10-point proposal from Iran, which President Trump had said would be a workable basis on which to negotiate. Trump goes on to say that the U.S. and Iran will be discussing a deal, any kind of peace deal, behind closed doors. So we'll keep you posted on any further developments as the day continues. This is Bloomberg Deals.
I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. equities are rallying as global risk sentiment improves following President Donald Trump's announcement of a 2-week ceasefire in the Iran conflict. That said, geopolitical uncertainty lingers, with reports indicating disruptions to oil tanker traffic through the Strait of Hormuz following strikes in Lebanon. Meanwhile, oil heading for its steepest drop in 6 years as fears of a prolonged energy shock ease. The move is also reinforcing expectations that the Fed could have room to cut rates later this year. Natural gas is falling in tandem. Elsewhere, Meta shares are jumping for their best day since January after the company debuted its latest AI model, its first since CEO Mark Zuckerberg embarked on a multi-billion-dollar overhaul of the company's AI organization to keep pace with rivals. Meta is up as they are continuing to look at this from a prize super intelligence group. And finally, Delta Airlines is surging on pace for its best intraday gain since July. That's after beating on first quarter profit and revenue. The company keeping its full year outlook despite projecting over $2 billion in additional fuel costs through June tied to the conflict in Iran. United Airlines and Carnival are moving higher in sympathy. Those are your midday movers. I'm Nora Melinda.
Nora, thank you very much. A very volatile market, and trying to navigate that are both deal makers and activist investors. How does a difference of a day when stocks are surging by 2-3% and down others change the job of activists? And up next, our investment committee is going to look at exactly that, activist investing, alongside the news that Bill Ackman is circling UMG. All of that to come on Bloomberg Deals. Welcome back to Bloomberg Deals. I'm Danny Berger. One of the big themes in our show today is activism. And in early March, I spoke to one of the more notable investors in the space, Starboard CEO Jeff Smith. Here's what he had to say about the role activists play.
Activism is about finding good businesses where we think they can perform better. And when we get involved in companies, there is the part that everybody focuses on, which is the early stage, where you may be on the same page as the company or a different page, and you're pushing them to do more, and you're pushing them to do it faster. But then you get to the middle stage where you're working with the company either on the outside or very frequently will be on the board and working with the company on the inside. And it becomes extremely friendly and collaborative where we're working together to try and create value.
Let's go to Scarlett Fu, who's taking a closer look at what we've seen from the cohort in 2026. Scar?
Well, the first quarter of 2026 marks one of the busiest periods of activist campaigns in the last 15 years. According to Bloomberg data, there were 110 campaigns targeting U.S. companies in this period, second only to the final 3 months of 2023. There's that high there. Smaller companies make up the lion's share, with only 30% of targets having market caps topping $1 billion. Among the most prominent, you mentioned Starboard. Starboard invested in and is pushing for changes in French fry maker Lamb Weston, Bitcoin miner Riot Platforms, and CarMax. Also, Elliott Investment Management building stakes in a string of companies. The biggest was a multi-billion-dollar investment in chip design software maker Synopsys. Elliott also took aim at a trio of consumer names: Align Technology, which makes Invisalign, J.M. Smuckers, the jam company, and Norwegian Cruise Lines. At the end of last year, Elliott took a stake in Lululemon and convinced PepsiCo to reduce its product lineup and slash prices. Another target we want to include, social media company Snap, which attracted attention from Irenic Capital as well as Randian Capital. And that's just a bit of a summary of what we've seen so far.
Yeah,
Danny?
Really busy period, Scarlett. Thank you so much. And that brings us to this week's Investor Committee, where we take you into boardroom debates in real time. And that is the theme of today, activist investors. Today's IC, Shaun Mathew, partner and head of shareholder activism and hostile takeover defense at Kirkland and Ellison. James Smith, founder and chief investment officer at Palliser Capital, an activist investor himself. And Elizabeth Gonzalez-Sussman, partner head of shareholder activism and engagement, mergers and acquisitions at Skadden. Thank you so much to our IC for being here. I want to start with the really heavy pace that Scarlett was just talking about. And Elizabeth, that heavy pace is now coming head to head with a really volatile market. How does that change things?
Well, it certainly creates a lot more opportunities, right? The activists can buy in a little bit more quickly at a lower price, and that's always attractive. This is about making money, right, for the activists. They're looking to buy in low, but also at good businesses that they feel like the value can be uplocked. But in a volatile market, you also may have some issues with executing your strategy. If there's a little bit more geopolitical issues, you may not be able to affect the strategic change that's going to increase the stock price, which is what ultimately the activists want.
Shaun, would you agree? Is that the tension of today's market?
Yeah, absolutely. I think the other thing to think about is you saw in the data, it didn't reduce activism as you might have expected, but it does impact the M&A market, right? And most activist platforms historically are focused on pushing for some kind of event-driven sale of the company, launch a strategic review, or you're even seeing activists launch bids themselves. That is harder, as you heard on the last segment, when M&A markets are less robust, financing markets are challenged. But it doesn't mean there's less activism. It just means either people are being patient or they're pushing for other things, whether it's capital allocation, operational change, or going after CEOs.
James, let me bring you into it and ask you that. Does macro volatility, has it made your job more difficult?
I mean, look, our approach is more focused on intrinsic value, and we do hedge our positions. And so at a level, the macro impact is limited. But to echo some of the points the other folks have mentioned, when the market is weaker and a bit more volatile, it can present more opportunities. And certainly in a number of the markets we focus on, Japan, Korea, and elsewhere, we've seen a good amount of opportunity presenting itself.
Well, in some of those opportunities, James, include the toilet company Toto, Ajinomoto, a seasoning company. Why those targets?
Yeah, I mean, Toto is one that everyone likes to mention because it is generally thought of as a toilet business, and has as its key product the famously heated toilet seats. But within there is a semiconductor business which focuses on creating components for semiconductor manufacturing equipment. And as such, we've found a hidden AI beneficiary in that company, which has been quite a good investment for us so far with plenty of upside. Ajinomoto, similar story. Again, there is a division in there that has got more of a semiconductor focus with an AI supportive angle. And that's a theme we like, despite the volatility we see in the market.
Elizabeth, Shaun, you both might find yourself on the other side of these activist campaigns. Elizabeth, what to you defines a successful response from a company?
Ultimately, it's performance, right? Like when you are performing better, your stock price goes up. That is the most successful outcome for both sides. But that's easier said than done. There's a lot of other macroeconomic conditions that can impact a stock price, and it's not just a strategic shift. And so you do need to also have genuine engagement, right? The trust between management, the board, and the activists become really critical so that you can explain why the stock price isn't being reflective and what other steps we can take together. That really is ultimately very important.
Shaun, what's the line between engaging, as Elizabeth was laying out, but also not caving in too quickly?
Yeah, and I think that's a really important point for boards and management to consider. It's, engagement is definitely the buzzword, and I think in the past you saw companies not engage, give activists the Heisman. That was a mistake. But there's been an over-rotation, I think, between, from engagement to capitulation, and it's just not necessary. I think companies ultimately are fiduciaries to all shareholders. They're not agents of the loudest shareholder, the most obnoxious shareholder. You've got to do what's best for the company. And as Elizabeth said, look, you got to listen. If you get good ideas from an activist or someone else, you should take those ideas. But ultimately, companies should do what's best. And I think they over-index a little bit on how good activists are at proxy fights, how successful they can be. They're actually really not that experienced in these contests, because I think, as your data would show, there's just not that many contests, and so companies, I think, should just keep that in mind.
True, and there's this argument of maybe newer comers to the scene, and James, this brings me to you. I mean, I have heard this criticism of Palliser that it's not, Elliott, it's not someone who's been around for longer, that you're a newer kid on the block, and therefore, why would companies engage with you as much as others? Is this an issue that you find yourself? What do you say to that type of criticism?
I think there's certainly an element of that, and I think it's important to explain to the company your ideas clearly. And I'm a great believer, a good idea, a little bit to your colleague's point on the panel, it will fulfill itself. And ideally, all these engagements would be private, they would be collaborative, and you would be giving a management, a team idea that they can make their own. Unfortunately, you do have instances where it moves beyond that, but certainly in a number of markets that we focus on, we've had great success on the private side of things. But I think, Danny, it's the quality of the idea that really develops the brand and the awareness that what you're suggesting is sensible.
Elizabeth, does it make a difference of the name of the activist coming in if it's someone who's been around for a while or is newer, or even, and I know, Shaun, this is something you looked at too, kind of like non-activist activist, someone who comes in that's not an activist investor but is taking an activist-like approach?
Yeah, well, I think it's more dependent on how much work they do. So if you take Elliott, they do a lot of diligence. You have to give them credit for that. And so they're coming in with ideas that I will say more often than not, boards are already looking at. It's not novel. There's drivers of underperformance. It's nothing new. However, they can be helpful in sort of thinking about things a little bit differently, or maybe timing it with a little bit more urgency. But when you talk about established activists versus first-time players, it really does depend on how much work people have done. And there are some small-time activists that do very little work, or it appears like they do very little work, and that creates a problem for a lot of boards and managements to take them seriously.
And I won't ask either of you to give me your take on what James is doing, but Shaun, I would love to get your opinion on this too, kind of the range of activists that we've seen.
Yeah, I mean, I would say full half of the activists we dealt with in the last quarter were not Elliott or Palliser. They were family offices, individual billionaires, just long-only institutional investors, but using the same advisors, using the same tactics as activists. And as Elizabeth said, some of them are super sophisticated and you kind of treat them the same way, others aren't, but they're more unpredictable because they don't have a track record. They may have totally idiosyncratic interests and goals, which makes it much harder for the company and its advisors to plan.
So James, you're trying to exist in this sweet spot of unlocking other value, be it AI from Toto, some of the semiconductor things. What's next on the agenda for you? What are you scouring and looking for more campaigns?
Look, I think there are a bunch of companies we're still invested in, big ones, the likes of LG Chem, of Japan Post, where we think there's a considerable upside, and we continue to engage constructively with management teams. There have been a lot of moves in stock prices in the software space, and it requires some time and some thought and some careful analysis. But our sense is that there ought to be value in some of those names. And even if it's just an improvement in capital allocation, really just returning capital to shareholders through buybacks, we think there's quite a lot of scope in that particular area. But again, it's very important to proceed with caution and analyze things carefully.
So if it is software companies, are you looking for ones with moats, James, or is it more of a quick, hey, this is a quick fix, they just need to return some capital?
Look, I think ideally you would be identifying companies with moats, with strong competitive barriers. Of course, in the environment we're in, with the proliferation of AI, that is quite a complicated thing to assess. And it really becomes kind of company by company, really doing a deep dive into their business, understanding what they do, how they do it, whether, for example, they have proprietary data and so on, and really developing confidence that they have that strength in the business to withstand new entrants and pressures driven by AI.
All right, we're going to have to end it there. Thank you so much to today's investment committee. Really appreciate your time. That is Shaun Mathew with Kirkland and Ellison, James Smith from Palliser Capital, and Elizabeth Gonzalez-Sussman, a partner with Skadden. Up next, M&A pipeline enduring despite the volatility caused by geopolitics and the war in Iran. We're going to catch up with Matt Zimmer, Global Head of Investment Banking at William Blair, on what lies ahead for deal makers. You are watching Bloomberg Deals.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. equities are rallying as global risk sentiment improves following a 2-week ceasefire in the war in Iran. That said, geopolitical uncertainty lingers, with reports indicating the Strait of Hormuz is still blocked and strikes continue in Lebanon by Israel. Meanwhile, oil is heading for its steepest drop in 6 years as fears of a prolonged energy shock ease. The move is also reinforcing expectations that the Fed could have room to cut rates later this year. Natural gas is falling in tandem. Also, energy-linked stocks are moving lower in the wake of the ceasefire. Jefferies analysts saying that with outcomes ranging from a diplomatic off-ramp to a frozen conflict or renewed fighting, markets appear to be pricing in beyond worst-case scenarios. And finally, Meta shares are jumping for their best day since January after the company debuted its latest AI model. It's first since CEO Mark Zuckerberg embarked on a multi-billion-dollar overhaul of the company's AI organization to keep pace with rivals. Those are your midday movers. I'm Nora Melinda.
Welcome back to Bloomberg Deals. I'm Danny Berger, and continued headline volatility crossing in the last hour as the U.S. and Iran prepare to negotiate a very tepid ceasefire. Bloomberg Washington correspondent Tyler Kendall has the latest, and she's live at the White House. Tyler, just how fragile is the ceasefire at this moment?
Hey, Danny. Well, at this moment, it appears that the ceasefire is very tenuous as we get these reports that attacks are continuing on Gulf state energy sites. Now, President Trump did post on Truth Social within the last half an hour, seeming to indicate that he feels that talks are on track to happen, saying that any discussion between the U.S. and Iran will happen behind closed doors. He also outlined what he says are the only, quote, meaningful points that are up for discussion between the two sides after earlier today saying that the U.S. would like to see an agreement that includes no enrichment of uranium for Iran and that the U.S. would work with Iran to extract their already enriched materials. Now, the president previewed, of course, that could be in exchange for some potential relief when it comes to sanctions and tariffs. But until that happens, we can't talk about that happening until we see this ceasefire hold. Danny, there's a lot of headlines, but the White House press secretary Caroline Leavitt will be giving us an update at the top of the hour.
Tyler, looking forward to your coverage of that and your coverage throughout the day. That's Bloomberg's Tyler Kendall at the White House. Now, Iran war-fueled volatility so far hasn't slowed the M&A pipeline, with global deal makers notching their best start to a year ever at a staggering $1.3 trillion in transaction values in the first quarter. We also saw one of the highest number of deals valued at $10 billion or more ever in a single quarter, that according to Bloomberg data. Joining us for more on what's ahead is Matt Zimmer, Global Head of Investment Banking at William Blair. Matt, always a pleasure to see you.
You too. Thank you for having me.
I'd say something about it feels really disconnected. The fact that there was such a massive first quarter and so much volatility. Is this current geopolitical volatility of stock swings every single day, concerns about energy markets, is it altering anything with M&A?
I would say across our team, there are certain sectors. So just to refresh you, we have 500 investment bankers focused on sectors. We have a technology team, healthcare, industrials, services, and aerospace and defense. Within those verticals, certainly there are some categories that have been impacted pretty quickly. Transportation logistics companies, an example. Fuel surcharges are up across multiple suppliers. The idea around delivery times being delayed, insurance costs up, have driven a lot of activity in that space to be muted pretty quickly. On the flip side, other sectors are performing quite well and still winning deals and moving forward. Industrials is an example, companies exposed to petrochemicals. There's been pricing elevation across polyethylene, polypropylene, packaging, bottles, et cetera, but they're passing a lot of that on to the consumer still. So our pipeline, our engaged pipeline right now of live mandates is at a record level. If these energy prices remain high for a sustained period, we will certainly see some decrease of activity in some of those verticals as well.
Is there a specific time period where that holds true? What does it take to derail some of that? Is it months? Does it need to carry through the rest of the year? What is sort of the barrier to halting these?
I think that, again, varies by sector, but certainly there are some sectors that will see that pain reflected more quickly than others. Flip side, we'll do about 200 M&A deals a year. The average transaction size, call it 200 to 2 billion. Our average deal size is about 500 million. Private equity is a big piece of that in terms of the investor base. There's almost been a rotation of investment appetite away from things, for the time being, from things like software and tech, and into what we could call essential services, HVAC services, facility services, infrastructure services, environmental services, more human capital intensive type businesses. Capital deployment in those categories is actually accelerated today.
Yeah, and we have that HVAC IPO coming up too, Madison Air, that was announced this week. I know that you've also been busy traveling and you've just come back from Europe. What are clients out there saying? Because it is a region that is much more exposed to an energy shock coming out of the Middle East than the U.S. is.
Yeah, so I was in continental Europe for a couple days and then also the Nordics last week, and I met with probably 25 to 30 private equity firms. The biggest topic that came up across all of these investors in that ecosystem was, how do we get into defense investment? The friction between the U.S. and NATO has certainly driven up defense spending across Europe. There are some private equity firms over there who have kind of led the way into the defense spending, and they're seeing their businesses kind of double, triple in performance in a short amount of time. If you think about the U.S. versus NATO, European countries, that trend in Europe right now is pretty pervasive. And if you think about a $1.5 trillion budget coming across in the U.S., certainly the A&D, aerospace and defense appetite in the U.S. is pretty strong as well. We have been on about 15 IPOs or equity issuances in the U.S. tied to aerospace and defense over the last 2 years. That's almost 5 times of what we would normally do. We're going on the road with 2 today that should price next week. So investment in aerospace and defense, primarily on the defense side, certainly on the commercial side, fuel costs are impacting the business a little bit. But on the defense side, there's a pervasive appetite across the U.S. and Europe to up investment in defense spending.
Just on the point of the commercial side, you mentioned this as well with some of the infrastructure logistics companies, that they can pass the fuel surcharge through to consumers, through to customers. How much room do they have to do that at the moment? Because it is this environment where inflation's been above target for 60 months now. There is a lot of price fatigue. How much wiggle room is there in margins right now?
I mean, I think they are attempting to do that. Our clients, a lot of them, and even in the public markets, they're attempting to pass that through as we speak. If you think about even the T&L providers that are out there, FedEx, UPS, the United States Postal Service, Amazon, they've all come out and said we're doing fuel surcharges right now. That's getting passed along to the consumer. On the industrial side, certainly passing along as well. There will be a breaking point where at some point these companies are going to have to absorb at least some or maybe all of the price inflation that occurs. My fear, my concern, I guess, would be heightened energy prices for a sustained amount of time. The input costs ultimately drive inflation inside of our economy. The Fed, who is continuing to talk about maybe reducing interest rates in the future, which is good for M&A, good for equity capital markets, maybe even flips and start saying we're going to raise rates. And we saw that play out in 22, 23. Interest rates going from 0 to 550 basis points, there's a 35% reduction in M&A volume over that time period.
I just wonder if, just quickly here, Max, we're almost out of time, but if this is a moment of tension for your private equity clients that are sitting on aging assets and need to sell it and are now facing more volatility and perhaps rates that aren't coming down.
Yeah, it is. And, we talked about this last time I was on. 30,000 portfolio companies out there, owned for an average of 7 years. DPI is not going away. The need for LPs to get capital back from the GPs is there, and it's staying. And so all these different products that have come out, the secondaries, the continuation funds, those continue to be pretty pervasive. I saw a stat, 14% of all the exits in the U.S. last year were through a CB, and 80% of all the largest GPs had done a continuation fund as well. So I think those products will continue.
Matt, thank you so much.
Thank you.
Really great to have you. That's Matt Zimmer, Global Head of Investment Banking at William Blair, and this is Bloomberg Deals. As we get to then, we've been talking about the impact of volatility on M&A. Say headline impact on markets, not really happening. We're still having this huge rally today, Scarlett.
Well, it's a relief rally because there's finally relief that the worst case scenario has not materialized. You're looking at gains of at least 2.5% for the major indexes, and oil down by double-digit percentages. But what's to come? Still a lot of debate to do.
A lot of debate, and Balance of Power will have that covered for you. That's up next, and this has been Bloomberg Deals.